Started discussing mastering price action with charts. Now, in tonight's class, I'm going to intermix the term security. I might say stocks or bonds, but I could say Facebook or Apple or the euro or Bitcoin. What I'm really talking about are all publicly traded financial instruments in which an open market exists. But it just gets very, very boring saying asset, 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 security, security, security over and over again. Similarly, I intermix the terms investing and trading. You know the difference, I know the difference. Most of us here are traders. We know investors take a much longer term position. But in either case, the basic concepts and techniques we talk about are equally adept. But again, it gets very boring just saying trading, trading, trading. Now, whenever I'm going to give a seminar, whether I'm doing personal appearances, whether I'm doing a webinar, whether I'm doing personal counseling, the main question I get asked all the time, right off the bat, what should I buy today? What should I sell today? Where will price be later? Will Google be selling at this and will Apple be here? Will Facebook be doing that? Will Bitcoin be doing that? Well, wouldn't investing and trading be easy if we knew the answers to those seemingly simple questions? But I don't have a Ouija board and I don't have a crystal ball. And neither does anybody else that I know of. So alas, if you're attending this class in the hope that technical analysis and using price action and charts has the answer to these seemingly simple questions, I'm afraid I must tell you early it does not. However, if you're attending this webinar with the hope that technical analysis, the use of charts and price action will improve your investing, I have good news for you. That it will do. Now, charting, has been around for a very long time. Japanese candlesticks have been around since the 17th century. But as recently as the 1980s, brokers and traders charted the movement of assets prices by hand with nothing but graph paper and a pencil. And when I first started trading, that's what we had to do. We sat there in the pits in a broker's office using a ticker tape with our graph paper and binders full of graph paper and all of our charts, and we're constantly putting dots on charts. Fortunately, the markets traded much slower in those days, and we were only concerned with charts about every hour or several hours, but it took a long time to put all those dots on your charts and fill them all in and draw the lines and extend your indicators. There was no computers. There was no nothing except ticker tapes. And then after a while, we got fax machines. But everything was done by hand. But in less than 4 decades, the charting industry has been revamped several times over. Today, we have these complex, advanced, intricate charts that decode everything. That's getting data directly fed into them. So it's got the most up-to-the-minute trading data, as well as automating the addition of all types of indicators directly on a chart. So you don't even need to calculate. Back in those days, we had to calculate stochastics or RSI by hand and then draw it onto our charts. Today, you push a little button and you tell it to add stochastics or you tell it to add MACD, and it keeps it up to date. There's nothing you have to do except interpret it. So today's data feeds and advanced computer programming offers all traders the most sophisticated charts with easy to add indicators and overlays. An online trader today has access to the same charts professional traders, banks, and hedge fund traders are using. That puts you on a pretty even keel, doesn't it? Charting software allows us in any market to see price moves, observe changes of various stretches of time, and combine this information to conduct market analysis and predictions. It's an absolute necessity for carrying out intelligent trades. Without it, trading currencies or trading big cryptocurrencies or trading oil or gold would be a lot more like gambling. Having highly dedicated by chance. Today, we use sophisticated charts, sophisticated instruments to make solid trading decisions. Now, we can expect to use a lot of time reading trading charts, which is much like learning to read a new language. You're not going to start out automatically being able to read a chart. Imagine when you were a child and you learned the alphabet. Then you were taught how to add them together and form words like cat and hat. Then you learned how to add those words together to make sentences. And then from those sentences, you can make paragraphs. And then you could write whole pages. And before you know it, you could write a novel. Well, it's no different than the language of charting. So once you put in the work to be able to fluently interpret the information on the screen, you'll be one step closer to executing successful trades. Many newbie traders ask which chart setup is best of the best. And experienced traders say that such a panacea simply doesn't exist. And it's the truth. Okay. We use what works best for us. Because if you've ever looked at a chart online, somebody who's offering a trading strategy, you see all these lines going all over the place. They look so complex. They look like horrible old road maps from an atlas. Because it's very hard to decipher somebody else's chart. When you're putting the lines on the chart yourself and setting up the colors and setting up how they look, guess what? You instinctively know what to look for. Now, there are different types of charts used in technical analysis for the CFD market. Some of the most common ones include line charts, bar charts, and candlestick charts. Now, all three of them use the same pieces of information because all that we have is the open, the high, the low, and the close. But they use them in different formats to help us interpret price differently. So let's go over the three main types of charts that you're likely to see as you trade the markets. A line chart is the most simplistic. We don't really use it for much of anything. Line charts are good at giving you a quick view of the overall market trend, as well as support and resistance levels. They are not really practical to trade off of because you can't see the individual price. Line charts are simply made by connecting a line from the high price of the period or the high price to the next, or the close to the close to the close. So as you can see here, a line chart is pretty simplistic. It doesn't give you any definitive price. Now, bar charts, which are my personal favorites, because in the beginning days, 40 years ago, actually it's 46 years ago now, that we were charting by hand. Okay, a bar chart was much easier to draw on your charts. A bar chart simply uses the open, the high, the low, and the close. You simply put a line across at the open, a dash across the open, a dash across at the close, a dot at the high, and a dot at the low, and connect these together. Now you may say, why are we wasting time tonight talking about this? But it's really important because you're going to see in a minute how much stuff you really don't know yet. Because a line chart gives us a lot more information about price movement. This is the same chart as you saw with a line chart, but now you see a bar and you can see the relationship of price levels. You can draw your support and resistance lines on there by seeing many closes or many opens at a particular price. Now, all of us knew this already because we all go straight. And since we've developed online trading, this is the favorite of all traders, and that's candlestick charts. And everybody thinks they can pop up a candlestick chart and they know exactly what they're doing, and they're making trading decisions, and they don't have any idea of what they're doing. Now, candlestick charts show the same information as a bar chart, but in a graphical format that is much more fun to look at. And that's, I think, is why so many people migrate to candlesticks. They like seeing the reds and the greens. Candlestick charts indicate the high, the low of a given period, just as a bar chart does with a vertical line. And the top vertical line is called the upper shadow, while the bottom is called the lower shadow. The main difference lies in how a candlestick chart displays the opening and the close price. Generally, it develops a body. Instead of putting a dash like you do in a line chart, a bar chart, you put a line across. And we connect these lines, and they give us the body of the candle, as you've seen here. So we have the body, we have the upper shadow, and the lower shadow. Now, you probably all know this already. It's not hard to find information. Most traders within the first week or two of trading know this, okay? Because they know how to look at a candlestick. They know what it looks like. They don't know what's called upper shadow or a wick. They don't know we call it a body. They just know they have these red and greens things they call candlesticks. Now, candlestick charts are the most popular of all three major chart forms. And as such, they are the type you will see most often used as you trade. They're also the type that I recommend you use when you learn and practice and trade with price action strategies. Because we spent more time in more modern times developing candlesticks. We know more about them. We have more information. So why traders love candlesticks? Well, candlestick charts are highly informative. It is not only the information every chart element contains, but also regularly repeated patterns that help traders to see the oncoming changes in the market. These patterns help us to see short-term direction and predict the bullish and bearish trends. Just one element, a candlestick, is able to reflect many parameters such as the market's open, high, low, and close over the unit of time. The color of the body indicates the result of the close. When the candle is red or black, it means the close was lower than the open. If the candle is white or green, it means the close was higher than the open. The shadows, long or short, show the high and the lows within that time frame. Now, the structure of all trade charts is pretty much the same. Their frame is formed with two axes, the horizontal X and the vertical Y, reflecting the time and the exchange rate of the chosen instrument. Easy to use interfaces include a zoom function, which allows receiving more data about the price in a certain time period, or to see the retrospectives of price movement. Now, some of the advantages of using candlesticks are candlesticks are easy to interpret and are a good place for beginners to start figuring out chart analysis. Candlesticks and candlestick patterns have cool names such as shooting stars and hammers and haramis and marabuzas, which help us to remember what the patterns mean. Candlesticks are easy to use. Your eyes adapt almost immediately to the information in the bar notation. Plus, research shows that visual will help with studying, so it might help with trading as well. Candlesticks are good at identifying market turning points, reversals from an uptrend to a downtrend, or a downtrend to an uptrend. But you need to learn about that later, and that's all the different candlestick patterns. As you see here, there's actually a total of 32 primary patterns. If you really want to trade using candlestick patterns, you have to learn all of these. Okay, you have to learn reversal candles, continuation candles, engulfing candles. Okay. But you don't need to learn them all to understand how to use candlestick charts and price action. But candlesticks will help you set buy points and exit points. They'll help you be able to predict when a market is turning. So before we move on to price action, you need to understand that bar charts also have patterns. And as I mentioned earlier, when we're talking about bar charts, they seem to be long forgotten in the past. I bet you all of you people out there can't tell me a single thing about bar chart patterns. You tell me about candlestick patterns, but you can't tell me much about bar stick patterns. So most traders focus on candlesticks and forget all about bar charts. Now, a bar charts are often called OHLC, open, high, low, and close. So here's how to read a bar chart and what each part of the bar means. So as we discussed earlier, we have the open, the high, the low, and the close. The direction that prices move during the bar is indicated by the location of the open and the close feet, or the dashes. If the closing foot is above the opening foot, then the price made upward progress during that bar or was a bullish session. Hence the reverse. So just like we have green and red candles, we have bars that show us bullish and bars that show us bearish sessions. The range of the bar is indicated by the location of the top and the bottom vertical bars. Okay, basically it's the same as the top and bottom of the candles. But we can also start seeing patterns in our bar chart. Because like I said, in the old days, 40 years ago, almost all of us were using bar charts because candlestick charts took too much time to draw by hand. That's why we have black and white candles, because we didn't have magic markers or color codes, and we didn't have computers. So if it was a bullish session, we left the candle hollow. If it was a bearish session, we just used the side of the pencil and colored it in black. But most people didn't use candlesticks. They would use bar chart patterns. So here you can see a nice bar chart pattern, 4 bar chart patterns for bearish and bullish sessions. But now you can see we have exhaustion bars, we have exhaustion bar tops, we have what we call Pinocchio bars. Okay, we have 2-bar reversal patterns, 3-bar reversal patterns, quiet 3-bar reversal patterns, and quiet 3-bar reversals. Okay, so there's all types of things we can see in the patterns of bar charts, as well as what we saw in candlesticks. So a bar chart also typically includes volume. How many shares or contracts were traded or changing hands. Therefore, it is also recommended you understand buying and selling volume when reading a bar chart. It takes a bit of practice to get used to reading a bar chart, especially when the price is moving quickly. Remember, the open is always to the left and the close is always to the right. But now that we know what charts we have to start looking at these charts, because price action is the movement of a securities price plotted over time. Price action forms the basis for all technical analysis of a stock, a commodity, or other asset. Many short-term traders rely exclusively on price action and the formations and trends extrapolated from it to make trading decisions. Technical analysis as a practice is a derivative of price action, since it uses past prices and calculations that can be used to make informed trading decisions. Price action analysis is the act of studying, reading, and interpreting the price movement of the market over time, which involves the use of raw price data charts to trade the market. In other words, no indicators. Okay, so that means no technical indicators, no RSI, no stochastics, no Bollinger Bands. By learning to read price action of a market, we can determine a market's directional bias as well as trade from occurring price action patterns or price action setups that reflect changes and continuations in market sentiment. In simpler terms, price action analysis is the use of the natural raw price movement of the market to analyze and trade it. This means you are making all of your trading decisions based purely on the price bars on a naked and indicator-free price chart. Now, all economic variables create price movement, which can be easily seen on a market's price chart. Whether an economic variable is filtered down through the human trader or a computer trader, the movement that it creates in the market will be easily visible on a price chart. So in other words, when the jobs data comes out strong, it's going to reflect on the price chart. You don't need to see the actual data. Therefore, instead of trying to analyze a million economic variables each day, you can simply learn to trade from price action analysis, because this style of trading allows you to easily analyze and make use of all market variables by simply reading and trading off of the price action created by the market variables themselves. Now, price action generally refers to the up and down movement of a security's price when plotted over time. Different looks can be applied to a chart to make trends in price action more obvious to traders. Technical analysis formations and chart patterns are derived from price action. Technical analysis tools like moving averages are calculated from price action and projected into the future to inform traders. Price action can be seen and interpreted using charts that plot price over time. Traders use different chart compositions to improve their ability to spot and interpret trends, breakouts, and reversals. We do this by using things like chart patterns, or what we could refer to as market structures. These are patterns that occur in price movement. These patterns have occurred over thousands and thousands and thousands of trading sessions. And by understanding the psychological makeup, or turning that psychological makeup that affects price into a pattern we can recognize, we can predict what the market reaction will be, because we can understand the psychology that's gone into that price movement in the past. We also have patterns like this on price, and we can use that to predict our target prices, where our breakouts should occur. And by looking at price and interpreting the price action, we could predict actual good trading decisions. So many traders use candlestick charts since they help better visualize price movement by displaying the open, the high, the low, and the close. Candlestick patterns such as the harami cross, the engulfing pattern, and three white soldiers are all examples of visually interpreted price action. There are many more candlestick formations that are generated off price action to set up an expectation of what will come next. These same formations can help apply to other types of charts, including point and figure charts, box plot charts, and so on. But simple candlestick patterns like the bullish engulfing and bearish engulfing, harami, dark cloud cover, and rising sun can all help us predict where price is going to. So here we have a typical price action chart and a bar chart at the bottom, or a graph at the bottom, showing us simple volume. For example, an ascending triangle formed by applying trend lines to a price action chart may be used to predict a potential breakout, since the price action indicates that bulls have attempted to break out on several occasions and have gained momentum. We can apply these onto our candlestick chart and use the candlesticks and the wicks and the body width to help us predict the target, the entry point, and the stop loss point. In addition to the visual formations on the chart, many technical analysts use price action data to calculate technical indicators. So price action is not generally seen as a trading tool like an indicator, but rather the data source off of which all tools are built. Swing traders and trend traders tend to work most closely with price action, eschewing any fundamental analysis in favor of focusing solely on support and resistance levels and to predict breakouts and consolidations. Even these traders must pay attention to additional factors beyond the current price, as the volume of trading and the time periods being used to establish levels that have impact on the likelihood of their interpretation being accurate. Now, interpreting price action is very subjective. It's common for two traders to arrive at different conclusions when analyzing the same price action. One trader may see a bearish downtrend, while another trader might see that price action shows a potential near-term turnaround. Of course, the time period being used also has a huge influence on what traders see in a price chart. The more tools you can apply to your trading prediction to confirm it, the better. In the end, however, the past price action of a security is no guarantee of the future price. High probability trades are still speculative trades, which means that traders take on the risk to get the access to the potential reward. So let's discuss how we can use price action analysis to find entries on a raw price chart. As a result of years of trading the markets, I have boiled down all I have learned into my own unique method of trading price action. This method consists of a handful of very specific action entry triggers that can provide you with a high probability entry into the market. Essentially, what we are looking for is a recurring price pattern that tells us something about what the markets might do in the near future. So in an uptrending market like this, we can watch for inside bar buy setups to trade in line with the trend, as they are often good continuation signals in the uptrending market. So in the example, we can see one price action trading signal that I like to use the most, and that's the inside bar setup. So keep in mind, to read price action in charts, we want to keep it simple. We don't want to get it complicated. Being able to read a price action chart is important to make the right decision. The problem many traders have is that they overcomplicate things, get easily confused, and they don't have a process in the first place and don't know what they are looking for. Ultimately, what's most important is once you've established a high probability trade, is establishing then your entry point, your exit point, your target, and your stop loss. Then you have to drop it into your risk management filters to see even if you can make that trade. So whenever I look at a market, I start by analyzing how swing highs and swing lows manifest on a chart. Okay. When I'm looking at my candlestick chart, I want to look at those upper wicks and those lower wicks. I also am always looking at the body of the candle, the size of that body. I don't pay much attention to the color. And most people shouldn't pay much attention to red candles or green candles. Okay. Too many people just look and see lots of red candles. It's going down, let's sell. So are we in a rally and is price making higher highs or higher lows? Are we in a bear market and is price making lower lows and lower highs? Or is the market in a transition period? If you want to get deeper, take a look at the distance between the trend waves and the swing points. It's a distance increased during a trend. Then it usually signals a healthy and a strong momentum trend. In other words, what we should be seeing is a set of peaks and valleys, push and ease, push and ease, push and ease, push and ease, when your highest high is getting higher and your highest low is moving higher. Your next higher high, and you always have a lower high. Your next higher high and your next lower high. This is a well-developed, solid momentum trend. Finally, look at the depth of the pullbacks. Small pullbacks during a trend usually show a strong trend. So in other words, when we're seeing the pushes and valleys, the pushes and eases, push, ease, push, ease, push, ease. We could see push, ease, push, ease, push, ease. We would like to see these eases as small as possible, okay, without much depth, because that means what's happening is these are created by buyers start buying. They push the price up. At some point, some buyers are starting to sell and pocket their profits. Other buyers who are watching that asset now have moved to the sidelines. When the asset starts easing down and clearing out those sellers, at some point, the buyers sitting on the sidelines want to re-enter the market because they think it's now a good price to get in. We want to see those buyers re-entering here, not waiting for it to go here to re-enter. That shows us the conviction of the buyers. Although this sounds very basic, this type of price analysis can already tell you a lot about the market that you were looking at and the price dynamics. So by combining the analysis of pure swing high and lows with the discussed technical patterns, a trader can make much more sense out of a chart. Then we want to look for support and resistance. Support and resistance to me is my most critical factor. Now, I'm only going to trade in a trending market that has a well-developed trend, because there's tons of trending markets. I don't need all those that have wildly trending markets and low quality trend. I'll throw them in a trash can because there's always a trade to be made. So I'm looking for a well-developed trend, and then I'm looking for my support and resistance areas that I can set up in short-term structures and look for high probability turnouts, turning points, or breakouts. Or great confluence in an area. Okay, I don't ever make or call a particular price a support or resistance level. I look for support and resistance zones. I look for multiple ways to give me support and resistance lines, and then I put them together and call it a zone. Okay, that zone is my support or because price isn't going to react at a specific number. Okay, and remember, we want to put it together. So instead of trying to pinpoint exact levels using thin lines, the larger support zone in the screenshot here will show you that once the support level becomes too obvious, we talk about a crowded trade. But see, we want to build a support area or a resistance area, okay? Because we don't want to define ourselves into such a tiny place that we can't make any decisions. Then we want to use price action wave analysis. Wave analysis is often overlooked topic in technical analysis, and when we hear the term waves, you typically think about Elliott wave theory, which I'm not so sure I've studied it, but I don't use it, and I'm not so sure I believe in it. When we combine wave analysis with support and resistance and swing high and low concepts, you already are looking at a robust method of trading. So let's go over and take a look at a chart with wave analysis on it. So you can define my pushes and E's as waves, okay, and wave development. So you can see that we come back to the analysis of swing waves. Swing highs and swing lows retest of previous swing points, and we combine that with other concepts such as support and resistance of supply and demand. Most traders overlook these simple principles when analyzing price action, although they can usually tell you all you need to know about a price chart. Then trend lines. And as I said, we look for well-developed trends. But remember, there's a difference between a trend and a trend line. Trend lines are arguably more subjective because drawing trend lines is more of an art than a science. When it comes to using trend lines, I suggest you focus on two main concepts. The initial break of a trend, which can signal a shift in trend direction, and those that break of strong trend lines and have at least two touching points. A retested trend line is a safe entry point. The retested trend lines after a break are marked with the blue arrow over here on the screen. So you can see we've got our trend lines on here, we've got our wave patterns on here, and we want to see that we have well qualified trends, not trends with two touches because we never got a third touch, not trends with one touch and got it broken. We want to look for 3 or more touches to establish a good solid trend. And then my fifth use is moving averages. Moving averages are another great confluence tool. There are 4 main ways of using moving averages to make sense of charts or time periods. So moving averages, they're an entry filter, only take trades in the direction of the moving average. They'll also give us general support and resistance tool. We can use moving averages to calculate other support and resistance levels so that we're building our zone. They help us time entry opportunities on a retest of a moving average during a pullback, and a moving average crossover can foreshadow a market transition period. The chart below shows 2 different moving averages, a slower 100-period moving average and a faster 20-period moving average. On the left, we see a slower uptrend with deep pullbacks and a long-term 100 trend. When this example, it becomes obvious that the optimal length of the moving average depends on the trend and the strength of the trend. So here we have our 2 moving averages. We look for the crossovers. Okay, we look for price remaining above the moving average. And when we use a combination of 2 moving averages or more, okay, we can see that anything in between the moving averages is untradeable. Anything above the moving average would only be considered for a buy scenario, and anything below the moving average would only be considered for a sell scenario. If you notice, all the tools we're putting together are only tools that are worked directly on price action. We're not going off the chart. We're not going anywhere else. We're looking directly at that candlestick chart, and we're analyzing exactly what is happening in price movement. Okay, we're not putting indicators below. We're not going other places. So price action trading is a trading methodology that uses the movement of price as inputs for making trading decisions. It allows you to tell a story of what the price is doing and making higher probability trades based on that story. It is a form of technical analysis. As we mentioned, price action trading revolves around using the price of the security to make informed decisions on what the market might do. But that doesn't mean we can't look at it in different ways. Now, if you notice on the screen, I've given you 4 handouts tonight. A guide to chart patterns, because you must know chart patterns in order to trade from price action. I've given you the investing.com introduction to technical analysis, which is an incredibly great resource guide. I've given you a handout on reading financial charts. And lastly, I've given you a guide on setting up support and resistance. So by combining these together, you can build a great system for price action trading and interpreting price action without getting involved in all that complex mumbo jumbo of technical indicators and all these other things of overbought and oversold and divergence. And make it simple. Make it stuff that you can understand easily, and you're actually interpreting price. You're not looking for, oh, did this number break above 92 and can I calculate? Or does this candle and this candle and this candle give me this pattern? Basically, if you stick with a few indecision candles, a few candles give you inside bar trades and outside bar, and they're really not interpreting candles. It's a pattern you're looking for. Okay. And you limit it to those few patterns. Bearish and bullish engulfing could be all that you could deal with. And then the rest. Understanding trend lines isn't complicated. Watching for swing highs and swing lows isn't complicated. Identifying a well-moving trend isn't complicated. Finding support and resistance isn't complicated. But now you put it all together into a trading system, a way to come back with high probability trades. Then you just have to figure out your entry points, your exit points, your target points, and then apply your risk management. So think of different ways to make trading easy. So have a good night. Thank you very much for joining us. Don't forget, if you want to learn more, go to legacyfx.com and either sign up for a demo account or sign up for their academy and start learning today. Have a great night now and have a good weekend.